Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. It was another volatile session in the market today with, I thought was a rebound in the afternoon after going down in the morning. Maybe it was going to turn out like yesterday, but it didn't quite work out that way. And many of the index closed in the negative territory. So we're going to talk about the market, of course. We're going to talk about predictions for the Fed tomorrow, and also dive into Verizon and their earnings that came out yesterday, or earlier today, I should say. And of course, the most important thing, answer your question. So if you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. Now, on the screen here in front of you is the ticker symbol SPX on TradingView, and there is a link in the description for a free account to TradingView. It is the best charting platform out there. But the SPX is the S&P 500. That's what it's tracking, and that's what it is doing here. So you can see it is below the 200-day moving average, which is this yellow line coming across diagonally on your screen. And we had that big green candle yesterday with that humongous wick because it was a dramatic drop early on in the day. Today, we have another big wick on the bottom, not quite as big as yesterday, but still a pretty decent size one there. Normally, you don't see this type of movement in the market. This is very volatile, and it is moving with big spreads through the day. There's actually a pretty big wick at the top of the candle for today as well. So the S&P 500 closed at 43.56. It got as low today as 42.87, and I do expect the S&P 500 to get as low as 4,200. I don't think we're out of the woods yet on this correction. I think the market, or the S&P 500 at least, can get down to that 4,200 level. It almost got there yesterday with a low of a low of 43.95. It almost got there yesterday, but not quite. So today, excuse me, I was wrong on that. It got to a low yesterday of 42.22. So it was only 22 points away from that target that I have here of 4,200. All right, today it got as low as 42.87. So again, it's getting pretty close to that level down there. But I expect the candle to be down here, not just the wick on the S&P 500. Now, the Fed is going to play a big role in what happens in the market tomorrow. So we are watching what they will do and say, and what they say and how they say it tomorrow. But we'll get into that on this episode. All right. I want to share with you real quick before I dive into the market overview. There are two what are called ETNs instead of an ETF, which is a basket of securities, and ETN, which is a senior unsecured debt security issued by a bank, which is different from an ETF, which holds assets like stocks. Now, an ETN is linked to a market index or other benchmark. Now, the two that I've been using successfully in this downturn are, the ticker symbols are SPXS, which I'm typing that on the wrong screen. All right, let's get our cursor where it needs to be over here on TradingView. SPXS. All right, this is the one I'm using. SPXS. All right, that's the ticker symbol. Now, when the market is in a downtrend, now you notice on the chart here for this thing's been moving to the upside. So why is the market going down? Well, this is like the complete inverse of what the market is doing, because that's what this is actually tracking. It is tracking the inverse of the market. So when the market is red and going down, this is green and going up. That's why you see here for today a little red candle. it was actually a little on the downside. Now, it was up 3.7% today. Yesterday, you have this bigger red candle, right? Well, yesterday, it was down 1.3%. The day before that, we've got a green candle, but on the S&P 500, it would have been a red candle, and you gained 5.89%. Now, these are very tricky to use, not in the sense of buying them. They're very easy to buy. It's just like buying an ETF, but they are riskier in the sense that if the market decides to rally like it did yesterday, then you can be caught holding the bag. So they're riskier in the sense that in a volatile market where price is moving rapidly, you can easily get underwater holding the bags on these. However, the bigger the risk, right? The bigger the reward. If we look at this in the inverse, right? Let me put the SPX, the S&P 500 back on the screen here just for a moment so you can see this. It's going to reverse. The S&P 500 has been in this big downtrend, right? Okay, now the inverse of that is going to take basically what you see here and flip it on its head. SPXS as the ticker symbol, and you're going to see it's going to swap, right? Okay, if you invested in this at the top of the market, right, which would have been about right here on this chart at about $15.82, and you rode the top of the market down to where the market is now, you would have gained in this inverse of the S&P 500, you would have gained 33.8%. While the market is falling, you would have been gaining during that fall. That's what I love about this ETN. I had to double check. I want to make sure. This is kind of new to me, so I've researched it a bunch, but I want to make sure I get these technical words right when talking about it. An ETN. Now, it's a great way to earn some money, right? To earn a profit while the market is falling. But if we look at yesterday, right? Yesterday there was this red candle and the market, it just switched, right? And we had a rally into the close. Well, today we started out like yesterday going down. But then midday, we turned it around and the market started moving up again. And then the last hour or so of trading, the market started going down. So I just wanted to share this with you. It is risky to use, but the reward is that if the market's going down, you're not losing money. You are gaining money. So if you want to invest some money into this ETN, then you're basically hedging your losses, right? You're hedging against your longs or even shorts that you have in the market. This is a way to hedge without getting into tricky options, because options can be very tricky and very hard for a new investor to understand. But just buying something like an ETF, an ETN, it's just like buying a single share of a stock. But this is in the inverse, and it's leveraged 3x, right? So this will move 3 times faster than the actual market will. That's why when you're in a correction, an actual correction, or even a bear market, these vehicles work great. These are great investment vehicles for a downturn. Now, this is the S&P 500 that it's tracking. I have one for the Dow, for the top, the 30 stocks in the Dow, and that one is SDOW, DOW. This one is also the inverse of how the Dow moves. Now, today it was up, it finished up 0.7%, but in the after hours, it's up 2.6%. And it's up in the after hours, I think, because there's going to be a lot of volatility in tomorrow's session because everyone's going to be waiting until 2 p.m. for the press release from the Fed. And then at 2:30 Eastern Time, Jerome Powell will give his press conference. And we'll get to hear how hawkish is he, or is he starting to dove a little bit, right? Are those hawk feathers starting to turn to dove feathers? I don't think that'll be the case, but I don't think he's going to be super hawkish. Okay. So, two ETNs that have been working really well for me right now in this down market. Obviously, yesterday with the big swing for the market, this SDOW, the ticker symbol, it was down 1.1%. Now, this one isn't three times the doesn't move in three times that the S&P 500 one does. The SPXS. This one just moves in sync, but it's inversed, okay? So when the market is green, when the Dow 30 is green, then you'll find this to be red. And when the Dow is red, this ETN will be green, all right? So let's measure this one. If you were here at the top and to where we are right now, that would be a 24% gain. Instead of losing money in the actual Dow, you would have been gaining in this. So it's a different type of investment vehicle that you can use that are not as complicated as getting into options to hedge against your longs or even your short-term positions. All right. So I just wanted to point these out to you guys. It has been working very well for me. I didn't get in at the very top of this thing, but I got in around here, around January 14th and then Monday the 18th. And it's been working pretty well since then for me, as you can see. And if we measure that just to show you, close here on the 14th was down here at 26.92, and then where we closed today, that's a 14% gain. Okay, not too bad. And let me just go show you from the 14th to where we are now in the SPXS. We'll measure from the 14th, the close right there, right about 1739. Up to where we closed today, because I'm still in them. That's a 21.69% gain so far. That's really nice to have instead of being in the S&P 500 index, right? And being down. So just a different type of investment vehicle that I wanted to share with you. Really simple to get into. It's just like buying shares. There, you can do it right on Robinhood or any other brokerage account. But beware, though. They're riskier in the sense that if the market does swing and rallies, then you're losing money at that point, right? You're going to end up with a loss on the day, just like yesterday. Now, this big correction that we've been in, it's been great when you're in the inverse of that, right? Okay, enough talking about that. I just wanted to share it with you. It's a new investment vehicle that I discovered that I wanted to pass that along to you guys as a very simple way to either hedge or just go short on the market, right? So really easy to use, really easy to invest in. And it's been working out so far in this correction. And if you want to get into it, want to give it a try, go ahead. Just make sure to do your research. It is risky, especially when you use a leverage account. As a matter of fact, on the SPXS, right? SPXS on Robinhood, it'll actually pop up with a notification letting you know before you can even buy a share that it's a leveraged investment vehicle. All right. And just gives you the warning. So you know what you're getting into. All right. So today the stock market indexes, they did close down, as we can see here with the S&P 500. In another volatile session, as investors are waiting anxiously for the FOMC monetary policy decision that will be announced tomorrow. And of course, digesting mixed earnings reports, right? Microsoft came out with a pretty phenomenal earnings report. I haven't had time to go through the call transcript that started at 5 o'clock, but the numbers weren't that bad that I looked at. And I'll share those with you in just a moment. But the stock was going down. So I think investors are very antsy about what decision the Fed will make tomorrow. Now, the Dow Jones, it did end up 67 points lower after shedding as much as 800 points earlier in the day. The S&P 500 dropped 1.2%, and the tech-heavy Nasdaq, well, it plunged 2.3%. Consumer confidence actually slipped in January as outlooks, they're just not looking very good. It hit a point to which it may introduce some potential weakness in the economic activity in the short term. So if confidence is slipping, that's not a good sign for the economy. Now, volatility is to be expected in front of the FOMC decision tomorrow. And Fed Chair Powell's press conference, we're going to be listening to that and, of course, discuss the committee's decisions. The uncertainty surrounding what the Fed Chair will say, how he will say it, has to be a contributor to the volatility. Investors' interest in growth stocks. This is another thing I want to bring up and talk about. Growth stocks have been getting hammered, worse off than almost any other uh, type of sector or theme in the market. Small caps have been getting beaten up, and a lot of growth companies fall into that small cap category. Now, I believe investors, they're completely leaving growth stocks right now, moving to value, moving to something defensive, something more comfortable, right? Some people may be moving to an inverse, an ETN, instead of staying in an ETF for following the index because of the correction that we've been in. But with the appetite for growth stocks kind of disappearing or hitting a wall, of course, now they will return. Investors will at some point come back to growth stocks. And most likely, that's when growth stocks will start going up. However, I've got a different point of view here. All right. I'm continuing to research stories out there. I want to find a good story to go along with a stock. And usually that's what brings me to a stock is the stock's story. Now, growth companies, they've got their growth stories. Value companies might have a different type of story. But for the growth companies, if you find a good story out there, that's what really drags you into the stock or the company to get you doing your research. So I'm looking for great long term opportunities. And one of the most compelling opportunities are found once investors or speculators have given up on a stock. And I think that SPACs are racing right towards that. They're racing down that road. This is an easy way to participate in funding rounds when private market company valuations are negatively impacted by multiple compression in the public markets. So I think certain SPACs will eventually provide that opportunity. The one that comes to mind right off the top of my head is SoFi. SOFI. SoFi was a SPAC, right? So this is a SPAC that's gotten beaten up. I mean, look at this, right? These mountain peaks, but then you see the other one with that big old candle wick there above my head. That's just crazy. But you look at SoFi, it is beaten down right now. And it was a SPAC. These are the companies that I'm talking about. Companies like SoFi, a SPAC that seemingly has lost the favor of investors and speculators too, right? And even traders for the most part. They're all leaving SoFi. But when I dial in here on SoFi, we see a bit of an anomaly to this downtrend that it was in. Right here on January 18th into the 19th, and then a big rally on the 20th. Well, there was big news that completely changed the fundamentals of SoFi. And that was their approval to become a national bank. Now, this stock right now, it's heading for $11 a share. Maybe it even gets as low as $10 or $9 a share. Can you believe that? A company that is heading down the path of becoming a national bank is losing all interest with investors and traders. See, traders came in on the news about the approval of the national bank. They made their attendees and they left. The stock was down 4% today. The stock's down 2% in after hours. 2 plus 4? Yeah, 6% down today. And if we look at where it is right now, we can basically go back to right before the announcement was made about the national bank. And it's almost to that point. It's got to get down closer to about $12.02, I believe. Yeah, $12.02 is where it closed right before the announcement came out. So it's getting right back down to that level. Like I said, it's headed for $11 a share. But the risk reward ratio for SoFi right now has never ever been better. Never been better than it is right now. So, this is an example of companies that I'm looking for. I'm looking for good stories that drag me into the company. Then I start doing my research. And I think what we're going to find is there's going to be a group of SPACs that have lost interest with investors, and investing in these companies, it's going to feel like we're investing in a private round before a company goes public, right? Investing in SoFi at $11 is an incredible investment opportunity. Not financial advice, of course. But that's an example of what I'm talking about. Okay. It's just awesome. All right. I have to plug this. I do it every day. So just bear with me for a second. to help investors towards quality stocks in this rocky and volatile market. We've put together our top 10 stocks list in categories like value, growth, dividend, and momentum. I know I say this every day, but I truly believe in these lists. They're constantly updated. As a matter of fact, we updated our momentum stocks list today. So click the first link in the description and get instant access after becoming a member, of course. It's to our uh oh my goodness, my mind just went blank. Totally blank. Live stream, right? Something always happens on the live stream. It takes you to our Patreon page. And it's a great way to help support our research, analysis, technical breakdowns, and you get the top 10 value, growth, dividend, and momentum stocks that are constantly updated. We've done the research so you don't have to. All right, let's look at Bitcoin. The last time I checked, Bitcoin and Ethereum were both doing good today. BTC USD on TradingView. Let the chart load there, and it's lost a little bit since the last time I looked at it. It's up 1/3% today, so it's getting pretty flat there. It's at 36,829 right this moment. Today it got as high as 37,579 and as low as 35,716. $2,000 swing there. So it's holding itself pretty well right now. And if we look at the past 4 days, we've been going up. After that big fall on the 21st, Bitcoin has been going up every day since then. So, with the death cross that occurred on the 14th, and you remember, we talked about it a lot leading up to it, for a whole week leading up to it. And I said, a lagging indicator. It means that we've been in a downtrend already for a while, and we've either hit the bottom or the bottom is close and a rally is incoming. That's what it means. So we didn't hit the bottom, but if this is the bottom that we saw yesterday, because the candle wick yesterday, it went pretty low yesterday to 32,933. So 32,933. If this is the bottom, then a rally is incoming. And who knows? Maybe the Fed tomorrow provides a little clarity, which relaxes the uncertainty investors are feeling. That's a possibility. All right, Ethereum, ETH USD on TradingView. And we've got a similar pattern, but not quite. Instead of moving up over the past several days, Ethereum has been moving sideways. All right. It's finding base support with its candles at about 24.15. The wicks are going a little bit lower, but the candles are settling on that 24.15 area, and it's at 24.39 right now. So it's barely moved today. Barely moved. Okay, there's Ethereum. And let's look at Cardano. We've been looking at it now for a few days. ADA USD on TradingView. And you can see today it's fallen a bit, 2.9% right now. It's at $1.03.5. That's where it sits right now. And the reason we've been watching this is where it's at right now, if we look over the price history here on the chart, this area around $1.05, it has been a support area for Cardano for several lows. Okay, it has been the bottom. So I'm looking at Cardano here as, is this the dip to buy? That's what I'm thinking, and that's what I'm watching. Is this the bottom? Right now, Cardano is actually down 20.9% year to date. 2022, it is definitely off to a rocky start, like I said earlier this week. It has not been a very good week. Very good month, that is, not just week. Okay, let's go into a few stocks rapid fire, and then we'll go and do a deep dive on Verizon. All right. First up is Microsoft. They reported their earnings after hours today. MSFT is Microsoft's ticker symbol. And I want to look at Microsoft not just on what they reported for earnings, but technically too. What do I see here for Microsoft? Now I'm getting this chart. I want to put another, I want to get another line on here. Okay. I want to get another line on here. This may not, yeah, let's see here. Remember, when you're putting your lines on the chart, you want to match as many points as possible. So it looks like I'm going to take this line and I'm going to match it to the tops here. So we have a top here, number 2, almost a third, number 4, 5, 6, 7, and then we had a blow off top there, and now we're in the correction. So now what I'm going to do now that I have this is I'm going to clone it because I want the exact same angles. And I want to go line it up down here with as many points of contact as possible. As a matter of fact, before I line this up, I need to get a few other lines out of here. I need to get a few lines off of this chart just to clean it up a little bit so I can have a better view, because I think there's something approaching for Microsoft that is good for investors, really good. I just need to clean this up a little bit. Almost there. One more to go. All right. I'll take the circle out. We know why the circle is there. It's been there for a while now. All right, now let's go match this up. As many points of contact as possible. Bam, right there. All right, so now what we have here for Microsoft is a trading channel, an ascending trading channel. And we can see the tops, right? We can see right here the March 2020 breakout or breakdown out of this trading channel right here. And then we can see the bottoms of the trading channel, right? Everything's touching and lining up. So with this, March 2020 was an excellent time to buy Microsoft, right? Once the crash hit, once the pullback happened, once the bottom had been secured, right? And things were moving back up, that was a great time to buy Microsoft. So, one more thing to look at here, and it's hard to picture. It's hard to see here. You know what? I was gonna do this, but let's just leave that out. Let me open this back up. All right. So with the bottom falling out of March 2020, and that being a great time to quote buy the dip, what's happening with Microsoft right now? Where is Microsoft? Well, look at that. Microsoft is outside of that line. Microsoft is out of the trading channel. The last time Microsoft was out of the trading channel on the bottom was March of 2020. That was the last time. Now it's out of the trading channel again. Is that signaling that Microsoft is a buy? Well, my answer would be not yet, because I think it can fall further. I really do. Even with these excellent earnings that just came out, this is kind of proving a point that I made yesterday. Now, Microsoft was down 2.6% regular session today, and it was up over, there it goes. It's up 1.1% right now. It was just 0.9%, but it just popped a little bit there. It's out of that trading channel. So investors and traders are both looking at this saying, well, wait a minute here. Look at Microsoft. It just reported great earnings. No, really, their earnings were good. Their EPS came in at $2.48, which beat by 16 cents on revenue of $51.7 billion, which for a company of Microsoft's size, that was a 20% year over year gain. And that beat estimates by $910 million. That's pretty good. And that year over year gain for a company that's over $2 trillion of a market cap can grow its revenue by 20% year over year. That's incredible. Now, the productivity and business processes, that was 15.94 billion. Intelligent cloud, 18.3 billion. More personal computing, 17.4 billion. Microsoft said the second quarter earnings were better than expected, as revenue from Azure rose 29% year over year. That's where the growth is coming from. The growth for Microsoft is coming from the cloud. Now, the earnings call began at 5 p.m. Eastern, so I wasn't able to hear it. But later on this evening, I'll go through and I will read the transcript and see if I can't find some things there. But as far as an entry point for Microsoft, if you have a long-term view, and Microsoft is now up 2.4%, so the earnings call must have been pretty good. The earnings call must have been pretty good for it now to be up 2.3% in after hours. And it's moving. All right. So they must have said something pretty cool in the earnings call. All right. So Microsoft, if you have a long-term view of Microsoft, an entry point right now makes sense. Getting in sub $300, that makes sense for a long-term view. If you're buying it for a decade or more, sub 300s is great. I'm being honest. Sub 300 is great. Yep, that is a little expensive, but if you can get in under 300, that is the best for a long-term holder, because Microsoft, it's still bringing in the money, baby. But for those a little more conscious or want to get a trade set up on this, then there's a point on here that looks even better. And if we're going sub 300s, then we want to go sub 280. Okay. Getting in under $280 would be a better entry point. Of course it would. Anything lower, right? The lowest we can go, the better. We're talking about an entry point for Microsoft. So, yeah, of course. But we got to be realistic here. Remember, the best investor is a realistic investor. They buy from pessimists and they sell to optimists. Remember that phrase. It's a good one for keeping your head on straight, sticking to your plan, and accomplishing your goals of becoming financially free. And that's what we're here to help with. All right. So sub 280 would be a great entry point for Microsoft. Now, if we're going sub 280, what if we could get to sub 260? That, my friends, would be even better. Now, I talked about this yesterday for Microsoft. Maybe around 250 a share. Maybe. There is an area of support at 250 for Microsoft. That makes sense. But there's also one at 280. So how far is this correction going to go? That's the big question, because that will determine, are we going sub 300? Are we going sub 280? Or are we going sub 260 to get in on Microsoft? All right, so it's something to think about there. All right, the next one I want to talk about, and this is a little different one. I don't think many people have heard about this one before, but F5, and its ticker symbol is FFIV for F5, Roman numeral there. So it's an electronic technology company, and it's been doing pretty good for itself. I mean, of course, it's being tripped up right now, but a lot of gap up, gap downs around earnings. So the PEG, or power earnings gap strategy, would be a good one to use. But the reason I bring them up right now is because they sold off in after hours. They were down 2.4% regular session, and they're down 13.5% in after hours. So they've dropped over 16% today. Over 16% today because of their earnings. So with their big sell-off, and let me just draw this here so you can see where they're at right now. They're sitting right here where this circle is, at $191. So they closed up here where all the candles are, but in after hours, they fell to where this circle is. That's a big drop. So big selling in the after hours. Why? Well, in the wake of their fiscal first quarter earnings, where it beat expectations on the top and bottom lines, here's the problem. They warned of supply chain constraints. Supply chain constraint warning. Red lights are going off. Boom, 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 boom. A warning like danger Will Robinson, right? That type of warning about supply chain. And the supply chain constraints are affecting its ability to meet demand. So it has the demand, but it doesn't have the capability because of supply chain issues to meet that demand. So if customers can hang on and wait a little longer to get their product, F5 has the demand. Revenues for the company rose nearly 10% to $687 million. And it was paced by product revenue growth of 19% and growth in global services of 2%. Of the product revenue, software revenues grew 47%, while systems only grew 1%. It's guiding to fiscal second quarter revenue of $610 to $650 million. That's below estimates of nearly $700 million. And on top of that, it's cutting back its full year revenue growth estimate to 4.5 to 8%. 4.5 to 8% from a previous expectation of 8, 9, maybe 10% growth. So, earnings like F5, they give us clues about the economy. They give us clues about other companies that are set to report earnings. They give us clues about what's actually happening in the economy. A warning that supply chain issues are still heavily affecting companies. That's a negative. That's a negative for the economy. Now, another company that reported today, Texas Instruments. The ticker symbol is TXN for Texas Instruments. They reported their Q4 earnings, and even though F5 was reporting their Q1 earnings, the majority of earnings will be Q4, all right, the fourth quarter. Now, the reason that some companies report different quarters is they start their fiscal year at different times, okay? So sometimes they can be a little off, but the majority of the companies, they do stick to the same calendar year. So right now we're in fourth quarter. That's what's being reported, but we're actually in the first quarter right now. So sales that are happening this moment today are recorded in Q1. So we're looking at Q4, October, November, and then December. So for Texas Instruments, they were down 2.4% during regular session, but up 3.4% in after hours. So they're getting a little reward here in the after hours. Now, they reported EPS of $2.27, and that beat by 33 cents on revenue of $4.83 billion. And that was 18.4% year over year growth that beat estimates by 400 million. Now, their first quarter outlook is for revenue in the range of 4.5 to 4.9 billion dollars and earnings per share between 201 and 229 a share. So, looking pretty good for Texas Instruments. Now, they've been trading flat here in range bound going back to May of 21. So, this little reward they're getting in after hours, quite frankly, I'm not sure if it can hold, but we will see. So if we're looking on the right side here where you see this little red box and blue box, I wish I had a pointer. I might have to figure out how to do that on the live stream. Get a pointer so I can direct you guys. But it's right here where I'm making these black lines move up and down. The blue and red here. So the red box is where they closed for the regular session at $173.96. The blue box, that's where they are right now, being up 3.47% in the after hours off of their good earnings report. And that's at $180 even right now. So they're getting a nice little boost, a nice reward. But the bottom of their trading channel, I mean, really the low point is $182. So they're still out of that channel. And if we're looking for the top of that channel, probably 194 would be the top there. Now you can see the range right there of where these stocks been trading at for a while now. Okay, so that's Texas Instruments getting a reward almost back into the trading range there, but it'll probably come down a little bit more. All depends on the Fed. So let's talk about the Fed right quick. The FOMC meeting that has already started, and it's a 2-day meeting. The policy decisions will be released tomorrow at 2 p.m. Now, Fed Chair Powell will hold a press conference, and it will be at 2:30 p.m. Now, this will move the market. This meeting will not produce any update summary of economic projections, though. That will happen on the next meeting in March, which takes place on March 15th to March 16th. Now, the CME Fed Watch tool, it indicates there's only a 5.6% probability of a rate hike tomorrow. In other words, if the FOMC elected to raise the target range for the Fed funds rate, it would be a huge surprise and most likely greeted initially with a decidedly negative reaction, like the markets would sink. And the reason being is that it would stoke fears that the Fed is going to be much more aggressive in tightening its policy to rein in inflation. Now, I think the Fed is late to raising rates and has continued with its asset purchases far too long. But I do think Jerome Powell, he understands this. And the shock value when it comes in with the rate hike, it'll be there. Now, I would be surprised, as I think most everybody out there would be, if a rate hike was announced tomorrow. The need for the Fed to regain some sort of inflation fighting credibility at this point, I don't know if it's possible. but it's far more important than the need to pacify the stock market. Now, some are claiming that the narrative about not wanting to prompt an unnecessary tightening of financial conditions with an aggressive policy for some spineless commentary. I think the Fed knows that it has already made a policy mistake, keeping things as loose as it has for far, far too long. Now, don't be surprised if you hear Fed Chair Powell spend more time and express a greater emphasis on the need to address inflation, the inflation side of the dual mandate that he has to pass at the press conference. That will likely keep the stock market on edge. So tomorrow's going to be a volatile day. So buckle up and be ready. Okay, let's talk about Verizon for a moment. VZ is the ticker symbol. Excuse me there for a moment. All right, Verizon. Now, I know it's not a big flashy company that a lot of people are interested in, but it does have a nice dividend, and over the years the company has been pretty steady. As we look recently, though, it hasn't been as steady as some dividend investors might want it to be. But there are some consistencies here. It has a dividend of 4.83%. That's only part of the story as far as the dividend goes. Now, if we're looking at Verizon here, I'm going to share with you a deep dive on Verizon. Let's see here. Hey, hi, hello, how you doing? No, please, it's going down a lot. Which one? Which one's going down a lot? I think that's an awful lot of them right now. All right, so here's my thoughts on Verizon right quick, and it just take a couple minutes. Neo, oh yeah, Neo. I would not be in Neo right now, and I would stay away from Neo for a while. It is definitely going down. Like I mentioned at the onset of the live stream, growth companies are getting hurt extra hard, and I think growth type investors are losing a bit of faith in these type of growth companies. And of course, since Neo is a Chinese based company, there's a lot of concern, extra concern, about the US and China relations, and what is the CCP going to do with a Chinese based company, delist them from the US? It's a possibility if there are any further downgrade in the communications between the two companies. So it's always a possibility. But me personally, I'm staying away from Chinese based companies. NEO is down 4.3% today, 1.6% in after hours. It broke down out of this symmetrical triangle, and I think it is going lower. I am in NEO. I am down 28%. Well, you've got a decision to make. You either cut your losses or you stay in it and you hope for the best. But yeah, technically, this is a negative. It's a bearish structure. If we measure this here, we go from this top to where it is right now, and that's a 42% drop. So it is technically in a bear structure, right? Anything over 20% down is in a bearish structure, and that's always a negative stance to be in. 10% down, you'd call that a correction, but 20% or more, and that is definitely uh, bearish, very bearish, very negative. Right now, the RSI is at a 30, so it's sitting right at oversold, but don't let that fool you, okay? It could sit down here oversold for a while before it uh, attracts any type of traders to come in and either day trade it or swing trade it, uh, or anything of that nature. So yeah, I'd stay away from this for a while. I think it's going down. I'm new to the stock market. I am learning. So far, not going well. Yeah, any investor who is new to this market, uh, this is the first correction that the market has had in, well, since March 2020. And if we take March 2020 out as an anomaly, then we haven't had a correction in the market since uh, October, December of 2018. That was the last market correction, and that was 20%. So if I go here to the SPX, which is the S&P 500, just to give you a quick snapshot overview of where we're at. If I go back here to 2018, take out 2020 because that was an anomaly, right? And let me just measure this just to show you. We go from the high right here to the bottom of oh, I got it. That thing's in the way. Got to move it out of the way. All right, so we go to the bottom there, and that was a 20% drop. 20% drop there in 2018. So that's what we are likely to see here, if not a little bit more, because the market has been moving so aggressively to the upside. So now if I measure from the top here down to where we are right now, we're at a 9.5% right now. So we're not even halfway through a correction. So if it's anything like 2018, 2018 was 20%. So if I go back here again to the top, and if I measure straight down 20%, keep going, keep almost there. All right, I'm gonna stop it right there. 20% puts the S&P 500 down here at 38.35. So we're not even, well, you could say we're about halfway, right? We still have more to go. I think we can easily get down here to 4,200 and past that, going on the downside. Now, if you didn't catch this at the beginning of the live stream, there is a very specific ETF that I'm using right now that is the inverse of what the market is doing. Now, what the inverse is, and I'll show you here, this is the S&P 500 and the way it's been acting, okay? So you can see that all these red candles, boom, 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 going down, right? Yesterday, we had a green candle. Now, the ticker symbol for the inverse of this is SPXS. SPXS. It's like an ETF, but it's called an ETN, okay? And if you look, the inverse has happened. Instead of boom, 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 red, it's boom, 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 green, except for yesterday. Yesterday was a red. This is what I'm in. This is an investment vehicle that you can use in a down market that you can gain in, okay? Without having to get complicated in options. If you were to get in at the top of the market as the market is going down to where we are right now, you would have made a 33.4% gain, okay? Now, the actual S&P 500 has lost about 10%. The reason you have gained 33% is because this very specific investment vehicle is leveraged 3 times. So for every 1% down, you get what 3 times, right? So you would get 3%. So the market is down just about 10% right now. So you have gained about 33% right now because you're 3xing what those moves are. The negative to it is that when the market does reach a bottom and swing to the upside and it's green for a day, you get a red candle like the red candle from yesterday. Now, this red candle from yesterday, let's see, it was down 1.3%. But if you would have got in somewhere at the top of the market and ridden that, even the loss from yesterday, there was a gain today of 3.7%. Now, it's an inverse, so it's doing the complete opposite of the S&P 500, and it's leveraged 3 times. So the moves are 3 times greater. This is a very easy investment vehicle to understand and use in a down market. All right, so I caught that you were new to investing, so I just wanted to share this with you because it's a great investment vehicle to use when the market is coming down, when the market is volatile. It's a great way to earn some money in a down market without having to worry about how to do options, right? Because you can short the market using options, or you can short the market using an ETN. And that's what this is. The ticker symbol again is SPXS. And there's actually one for the Dow Jones. Now, the Dow Jones has 30 stocks in it. So if the Dow Jones is declining, then you can use SDOW. Now, this one isn't 3x'd, so it moves exactly in the same percentages as the Dow Jones does, but in the inverse. So when the Dow is red, this ETN is green, okay? So just another way that you can short in a simple way. All right, that's not overcomplicated by options. So I hope that helps you out a lot. Thank you so much for answering my questions. I really appreciate it. You are welcome. That's what I'm here for. Every day around 5 p.m. I start the live stream and I go and answer your questions. Talk about a couple things along the way that are interesting. All right, if there's no other questions, I'm gonna hop back to Verizon for just a moment because it is a good dividend-paying stock, but it is a bit on the shaky side at the moment. So, VZ, if you have any other questions, feel free to type them in. I'll stop and go over them just like I did for your questions. Uh, so the stock has been moving around, but it doesn't move really in big percentage movements. And you've got a 4.8% dividend, which is only part of the overall dividend. Remember that it's not just the dividend yield that's paying you as an investor. There's other things that companies can do to reward investors. Now, Verizon's consistency is totally on display with its earnings report after the telecom giant reported better than expected Q4 21 results, including its eighth straight quarterly EPS beat. The upside result can be linked to Verizon's aggressive push to secure the country's most extensive 5G coverage. After Verizon shelled out a whopping $45 billion last February in the C band auction, it's vital that the company shows a solid return on its investment because that was a big investment. With more than one third of Verizon's wireless customers now having 5G capability devices, it's evident that it's a massive bet is going to pay dividends. However, whether those dividends, including the addition of 558,000 post-paid wireless phone subscribers in Q4, are worth the steep price is still up for debate. Notably, rival AT&T, ticker symbol T, another decent dividend stock, spent about half as much as Verizon in that same auction, but it added 880,000 postpaid phone subscribers in Q4. An argument can be made that Verizon's wireless phone subscription ads are worth more than AT&T's due to Verizon's premium 5G service. The problem with that assertion is that Verizon's adjusted earnings before taxes declined in both consumer and business segments, dropping 120 basis points and 110 basis points on a year over year basis, that is. Meanwhile, the company's long term debt ballooned to $143.4 billion. That's up from $123.2 billion in the year earlier period. More time will be needed to fully decipher whether Verizon is generating enough bang for its buck. When AT&T issued its full Q4 report tomorrow morning, that is, having already provided some Q4 metrics on January the 5th, another data point in this competitive landscape will be revealed. For now, what I can definitely say is that Verizon is performing reasonably well, as illustrated by these points. In the consumer segment, Verizon reported 336,000 phone net additions, up from 267,000 in Q3 21, while the business segment experienced a 3% drop in total revenue due to legacy wireless declines. Strength in small and medium sized businesses fueled the segment's best quarterly net phone addition performance since the onset of the pandemic. For the quarter, the segment reported 222,000 phone net additions. The work from home trend, well, it continues to support Verizon's broadband segment, which added 106,000 net new customers, including 55,000 Fios internet additions. Verizon provided upside EPS guidance of 540 to 555 for fiscal year 22, even as it projects 16.5 to 17.5 billion dollars in capital spending. Overall, Verizon registered another solid performance. There is room for some disappointment because the staggering amount of capital it deployed into 5G infrastructure has yet to produce meaningful higher adjusted earnings before taxes, flat or revenue growth. Okay. Howdy, how's it going, Mario? Any questions? I'd be glad to answer them for you. I'm about to wrap things up, as a matter of fact, but if you have any questions, feel free to ask. Uh, I want to talk about Carvana for just a moment. Uh, uh, Big day tomorrow. Let's see what St. Powell says. Yeah, I think he is going to come out and talk about inflation, and inflation being the key driver to their decision making. I don't know if he's going to come out any more hawkish than he has already been. I don't think there will be a rate hike tomorrow. If there is, it's going to crash the market. But I'm not so sure that Powell right now is worried about the market as much as he's worried about inflation. So I did a segment earlier in the video. If you want to back up to that and watch it, a forecast on what I think the Fed's going to do tomorrow and what Powell's going to do tomorrow. But I just gave you the quick summary of it, so you don't really have to go back and watch it. But yeah, so that's what I think. I think the market is going to be volatile in the morning. I think it's going to shake and rattle around, and then 2 o'clock is when they release the press release, and then at 2:30, that's when Powell will speak, and the market will move based off of what he says. Awesome. I'll watch it later. Cool. No worries. All right. I want to talk about Carvana for a quick moment because this was an interesting upgrade by a Morgan Stanley analyst. Now, Carvana's ticker symbol is CVNA. And when you see the chart load here, it was down 7.2% today, and it's been dropping hard and fast since September. I guess that was it. Yep, September of last year, and it's just been falling right on down. Now, it has earnings in over a month, so nothing to talk about there about earnings. But Morgan Stanley sees Carvana as a stock that may be oversold following its more than 50% drop over the past 90 days. Okay, I get that. Oversold, sure. RSI is at a 29, but that's barely oversold at this moment in time after dropping 7.2%. Okay, so we got that. But analyst Adam Jonas, who he's been right about things in the past, but he thinks that Carvana under $140 is a better risk reward than when the stock was at $40 2 years ago. Well, $40 2 years ago and $140 today is a pretty big difference. So, going back to what he said, he believes that under 140 today is better than $40 2 years ago. So, what does 2 years give Carvana? 2 years gives Carvana the ability to grow its business, to take market share, to build its brand, to work out the kinks of a growing business, right? The growing pains that businesses feel. So, if 2 years can do all of that for Carvana, what does Adam see? Well, he believes it has only solidified its moat or competitive advantage in recent years. And this is the fun part of his quote, remains an apex predator in the auto retail market. An apex predator, Carvana, with their friendly car vending machines, right? Okay, that's interesting. I told you I found this one interesting, and it's the whole reason I'm talking about it. Now, the bull case from the firm on Carvana calls for it to continue to gain market share and become the leader in online retail. Carvana is seen potentially growing to sell more than 2 million units, representing about $90 billion in revenue versus $13 billion in 2021, to mark a 24% revenue compound annual growth rate all the way until 2023. That would be phenomenal if that did happen. What are the odds or the probability that Morgan Stanley is right on this one? Well, they've done their research. I can at least give them that. And Morgan Stanley does reiterate an overweight rating on Carvana, and it assigns a price target of $430. $430. It's at 146 $146 right now. That's a long ways to go. Now, I see Carvana as having short-term risk in the market as the market continues to punish growth stocks. So, maybe wait for a bottom. If you feel like Carvana is an apex predator of the used car market, then by all means, jump aboard when the price is right. Remember, they said under 140, there's still $6.53 left to go. But I do find it interesting, and I do think Carvana is the leader in online auto retail. I believe that too. I don't think anyone else, Shift, any of the other ones, can catch up to the market share that Carvana has. It is also possible, I don't know what the probability may be, but it is possible that if Carvana stock keeps going down, think about Microsoft and Activation Blizzard. Activation Blizzard was a big enough company. It was a big enough company that Microsoft couldn't go after with its full valuation. But once the stock had been under pressure and started selling off and selling off and selling off because of all the rumors and everything happening within the HR and within the company, all the nasty rumors bringing the stock down, Microsoft was able to pounce and get a good deal on the company because the stock had fallen so much. So with Carvana stock falling, could it be possible that either a rental company or a mainstream legacy automaker decides to put a bid on Carvana? It's possible. And it's one to watch as the stock continues to fall. Another possibility here for Carvana is that it is really the apex predator in the used car retail space. And if that's the case, watching for an entry point is a good idea for a company that's got long-term growth. But if we look at the stock here, now this bottom blue line right here, okay, that line is at $130. So that's well below $140 level, which is just a little bit, uh, just about maybe a quarter inch or so above that line there. I know it's hard to see on your screen, but if we're looking at below 140, um, really, for me, if this thing could get back down under $100, that's the buy signal. Under 100 would be phenomenal. And if the market continues to punish growth and continues to go down, and we get ourselves a real market correction of 20% or more, then I could see that happening. All right, that's everything that I wanted to talk about today, ladies and gentlemen. So I want to thank you for joining me. And remember, go back to the beginning of the live stream if you're watching here at the end and catch what I said at the beginning. I talked about Fed predictions and what I think tomorrow is going to bring, but I do think it's going to be a lot of volatility in the morning. I also talked about two, not ETFs, but ETNs that are an inverse of the market that have been working really well for me lately, because when the market goes down, those actually go up. So there's one that's actually it's leveraged 3 times over. So if the market goes down 1%, you're actually gaining 3%. So when the market is down 10%, you've gained 30%. It's a really good investment vehicle to use in a down market. So check those out. Again, the ticker for the S&P 500, the one I'm using right now, is SPXS. SPXS. That's the ticker for the one I'm using. But do be careful, because if the market does swing and go up and it's in a rally, then you're losing money. So do be careful. The risk reward on that is it's big risk for big reward. All right, everyone. Thank you so very much for watching, and I will see you in the next video.